Before we begin, I want you to imagine something. Imagine waking up tomorrow and discovering that the price you have trusted for years is no longer real. Imagine finding out that the number flashing across trading screens was never backed by what you thought it was backed by. Today, I need you to understand that what is unfolding in the silver market right now is not routine volatility, not another short squeeze headline, and not social media hype. It is something far deeper, something structural, and it may represent one of the most important inflection points in modern commodity pricing. But first, I want you to do something. Tell me where you are watching from. Drop your country in the comments, because whether you are in the United States, Canada, the United Kingdom, Australia, Germany, India, or anywhere else in the world, what we are about to discuss affects you directly if you hold silver, trade silver, or simply care about how the global financial system functions. What is happening right now is not normal behavior for this market. We are entering a window that could determine whether the paper-silver structure continues operating as it has for decades, or whether it faces the kind of stress that forces a structural repricing. Today marks first notice day for the March silver futures contract on the COMEX exchange, and the numbers tied to that contract demand serious attention. There are approximately 360 million ounces of silver, represented by open March futures positions. Meanwhile, the actual physical silver sitting in COMEX vaults available for delivery is somewhere between 95 and 105 million ounces. Even at the high end of that estimate, the system is carrying 3 to 4 times more paper claims than physical metal ready for delivery. But that simple comparison understates the severity of the imbalance. When you account for the distinction between registered and eligible inventory, the ratio changes dramatically. Registered silver is metal specifically designated and ready to fulfill futures delivery obligations. Eligible silver is stored in vaults, but not formally committed for delivery. According to analyst Danny Krypton, when you isolate registered inventory, the effective paper-to-physical ratio approaches 360 to 1, and that means for every single real ounce that is officially deliverable, there are roughly 360 paper claims tied to it. Pause for a moment and consider what that implies. The system functions on the assumption that almost no one will demand delivery at the same time. Now here is why the timeline matters. Over the past several sessions, the March futures contract has significantly outperformed the May contract. In normal market behavior, traders roll forward into later months to avoid delivery. That is standard practice. But what we are seeing now suggests something different. Traders are concentrating in the near-term contract, the one that settles with physical delivery beginning today. That behavior signals urgency. It suggests demand for near-term settlement rather than deferred paper exposure. At the same time, silver lease rates have risen for 6 consecutive days. Lease rates represent the cost institutions pay to borrow physical silver. When borrowing costs increase steadily, it indicates tightening availability. Institutions are willing to pay more to access physical metal immediately. Adding to that signal, silver swap rates have fallen to their most negative levels in weeks. Negative swap rates mean market participants are paying a premium to secure physical silver now instead of waiting for future delivery. These indicators are not isolated data points. They align in the same direction. Physical supply is tightening precisely as paper claims face potential delivery demand. Inventory data reinforces that story. COMEX silver inventories recently fell below 100 million ounces for the first time in modern history. That milestone alone should command attention. We have decades of inventory data, and never before have registered levels sat this low relative to open interest. Withdrawals are not slowing either. Current vault drainage is averaging approximately 785,000 ounces per day. Nearly 800,000 ounces leaving vaults daily. That pace, if sustained, steadily erodes the already thin buffer supporting futures delivery. To understand the bigger picture, we need to step back to global supply and demand fundamentals. Annual global silver production runs around 820 to 830 million ounces. Industrial demand alone, driven by solar panels, electronics, electric vehicles, artificial intelligence hardware, and medical equipment, consumes approximately 680 to 700 million ounces each year. That leaves limited surplus for investment demand. And currently, the market is not balanced. It is running a deficit estimated between 40 and 50 million ounces per month. Since 2021, cumulative shortages have approached 820 million ounces. Those figures come from institutional research and supply-demand analysis, not speculation. Historically, the futures system relies on a simple behavioral assumption. Only 3 to 5% of contract holders stand for physical delivery. The rest roll forward or settle in cash. That mechanism allows paper claims to vastly exceed physical inventory without immediate stress. But recent data challenges that assumption. In a prior delivery cycle, demand approached 98% of contract holders standing for delivery. 98%. That is not a statistical anomaly. That represents a different market dynamic entirely. Consider what happened during the dramatic price collapse earlier this year. Silver fell sharply from $121 per ounce to $64 in a single session, one of the most violent price drops in modern history. Conventional logic would suggest that physical demand would weaken during such a collapse. Instead, vault data showed 3.3 million ounces withdrawn on that very day. During a severe price crash, sophisticated capital chose to remove physical metal from exchange custody. That action reveals a critical distinction between price and perceived value. The latest inventory reports show futures positions increasing by 2.3 million ounces, while overall exchange inventory declined by 2.6 million ounces. That results in a net reduction of approximately 300,000 ounces in tradable supply. The direction remains consistent. Metal is leaving vaults while paper exposure persists. Now consider corporate behavior. A major technology manufacturer recently secured a 2-year exclusive offtake agreement covering the full output of a Mexican silver mine. That decision removes an entire mine's production from open market circulation. This is not speculative hoarding, it is supply chain security. When corporations move directly to producers and lock in long-term supply, it reflects concern about future availability. Overlay that with geopolitical developments. China controls roughly 70% of global refined silver output. Recently, silver was classified as a strategic resource, tightening export controls. That shift reduces the probability that Western exchanges can rely on Chinese refined supply to ease shortages. Meanwhile, Shanghai silver prices have traded at premiums ranging from $10 to $20 above COMEX levels, occasionally approaching 30% before tax adjustments. Wholesale physical premiums briefly reached 45 to 48%. Those discrepancies signal regional dislocation between paper benchmarks and physical markets. Exchange-traded funds backed by physical silver have reached their highest holdings in weeks. Institutional capital appears to be favoring metal-backed exposure rather than derivative-heavy positioning. That preference suggests caution regarding delivery risk. Yes, the exchange retains mechanisms to manage stress. Eligible silver can be converted to registered status. Cash premiums can incentivize settlement. Emergency provisions exist, but cash settlement is not equivalent to physical delivery. It resolves contracts financially, yet it confirms that leverage differs fundamentally from ownership. The question becomes mathematical. What happens if delivery demand rises to even 25 or 50% instead of the historical 3 to 5%? At current withdrawal rates, at current registered inventory levels, the system would require extraordinary intervention. Converting eligible inventory depends on willing sellers at prevailing prices. If holders anticipate substantially higher prices due to structural deficits, their incentive to convert diminishes. Meanwhile, broader economic stress adds context. Housing affordability has deteriorated dramatically, with median prices rising from $270,000 to $415,000 over 5 years, while wages increased only 29%. Mortgage rates climbed from 2.7% to around 6.3%, widening the affordability gap. Approximately $127,000 in household income is required to qualify for a median-priced home, compared to median income near $80,000. Pending home sales have fallen to record lows. Financial strain historically pushes capital toward tangible assets. All of these threads converge at this moment: inventory depletion, rising lease rates, negative swaps, delivery demand surges, corporate supply lockups, export controls, Shanghai premiums, macroeconomic stress. None of them alone guarantees crisis. Together, they describe a system operating near its structural limits, and today marks the beginning of a delivery cycle that will test whether paper claims can continue expanding against a shrinking physical base without consequence. This is not about panic, it is about math, incentives, and confidence. And confidence is fragile when numbers stop aligning with reality. As we move deeper into this situation, it becomes essential to understand that markets rarely break in dramatic fashion without first sending repeated warnings. Those warnings are often dismissed because the system has held together before. This time, however, the signals are aligning in a way that demands careful attention. The combination of delivery pressure, vault depletion, corporate supply lockups, and international export tightening is not random noise. It is structural stress surfacing in measurable form. Let us focus again on delivery mechanics, because that is where theory meets reality. Futures contracts are promises. They represent obligations that can be settled financially or fulfilled physically. For decades, the silver futures market has operated smoothly because the overwhelming majority of participants never request the metal. They roll contracts forward, close positions, or accept cash settlement. That behavior allows a small pool of registered inventory to support massive volumes of paper exposure. The entire structure relies on the assumption that demand for physical settlement remains minimal. But assumptions can change quickly. When delivery demand begins rising beyond historical norms, leverage becomes visible. A system operating at 360 paper claims per ounce functions only if those claims remain theoretical. If holders begin acting on those claims simultaneously, even partially, strain becomes unavoidable. A move from 3 to 5% delivery demand toward 25% would alter the balance entirely. A move toward levels near 98%, as seen recently, would represent a different market altogether. The exchange does have tools. It can encourage cash settlement by offering financial incentives. It can convert eligible inventory into registered status. It can modify contract terms in extreme circumstances. These mechanisms are designed to preserve order and prevent technical default. However, every intervention carries a message. Cash settlement signals that physical supply is insufficient at prevailing prices. Emergency provisions signal strain. Conversion from eligible to registered inventory depends on cooperation from holders, who must willingly release their metal. Here is where incentives matter. If investors holding eligible silver believe the structural deficit supports significantly higher prices, they have little reason to rush conversion at current valuations. Why convert metal at $90 if underlying supply dynamics imply $150 or even $200 as equilibrium? The eligible category may look like a buffer on paper, but its availability depends on price expectations. In a tightening market, that buffer becomes uncertain. Meanwhile, physical demand outside the exchange continues evolving. Industrial consumption is not slowing. Solar panel deployment remains aggressive. Electric vehicle production expands. Semiconductor fabrication for artificial intelligence infrastructure requires increasing amounts of conductive metals. Medical equipment and electronics maintain steady draw. These sectors operate on long planning cycles. They secure supply ahead of shortages rather than react afterward. When a major technology manufacturer locks in 2 full years of output from a producing mine, that decision reflects forward-looking analysis. It removes supply from open market liquidity. That single agreement represents millions of ounces redirected from exchange-based pricing mechanisms into private channels. If similar agreements multiply quietly across industries, visible exchange inventory could decline even if global production remains stable. Add the role of China to this equation. Controlling approximately 70% of refined output places extraordinary influence in one jurisdiction. When silver is designated a strategic resource and export restrictions tighten, global supply chains shift. Western exchanges cannot assume consistent inflows from Asian refiners. The result is regional pricing divergence. Shanghai trading at premiums of $10 to $20 above Western benchmarks illustrates that divergence clearly. At moments when wholesale premiums briefly approached 45 to 48%, the disconnect became impossible to ignore. Premiums do not emerge from speculation alone. They emerge from immediate scarcity. If buyers are willing to pay dramatically above quoted paper prices to secure physical metal, that indicates mistrust of paper availability. Markets communicate through spreads. When spreads widen persistently, they reveal stress beneath surface calm. Exchange-traded funds backed by physical silver add another layer of confirmation. ETF holdings reaching recent highs indicate institutional preference for metal-backed exposure. Investors seeking simple price speculation could use derivatives. Choosing physically backed structures suggests prioritization of underlying asset security. It represents quiet positioning for potential decoupling between futures pricing and tangible supply. Now consider broader macroeconomic conditions. Housing affordability deteriorating sharply over recent years has compressed household balance sheets. Median home prices rising from approximately $270,000 to $415,000, while wages increased only 29% created structural imbalance. Mortgage rates rising from 2.7% to roughly 6.3% compounded payment burdens. Qualification income near $127,000 compared to median earnings around $80,000 leaves a substantial affordability gap. Pending home sales falling to record lows signal stress. Financial pressure historically shifts capital behavior. When traditional asset classes appear unstable or inaccessible, attention turns toward stores of value not dependent on credit expansion. Precious metals often benefit during such transitions. Silver, carrying both industrial utility and monetary history, sits at a crossroads between commodity demand and wealth preservation. The global silver deficit, estimated between 40 and 50 million ounces per month, is not trivial. Cumulative shortages approaching 820 million ounces since 2021 represent material depletion relative to annual production around 820 to 830 million ounces. That cumulative figure essentially equals an entire year of global output. Deficits of that magnitude cannot persist indefinitely without price adjustment or demand destruction. Demand destruction has not materialized at scale. Industrial expansion continues. Investment interest remains resilient. What makes this period distinct from previous episodes is the composition of demand. The widely publicized retail-driven surge several years ago largely involved paper vehicles. Social enthusiasm did not translate into widespread physical delivery requests. Today's environment looks different. Banks are issuing substantial delivery notices. Quantitative trading firms accumulate metal-backed ETFs. Corporations negotiate direct offtake agreements. Governments classify silver as strategic. Institutional capital appears engaged at multiple levels simultaneously. When sophisticated participants alter behavior collectively, it merits attention. Markets move not only on data, but on expectations about future constraints. If large players anticipate tightening supply, they secure position early. That behavior itself reduces available liquidity, accelerating tightening. It becomes a feedback loop. The withdrawal rate near 785,000 ounces per day may seem small relative to annual production, yet against registered inventory below 100 million ounces it carries weight. Sustained outflows gradually erode the cushion supporting future settlement. If delivery demand spikes concurrently, pressure compounds. Each ounce withdrawn is one less ounce available for contractual fulfillment. Critically, none of these developments individually guarantee breakdown. The exchange may navigate stress successfully. Cash settlement may satisfy most participants. Prices may rise enough to incentivize supply release. However, the margin for error narrows as ratios expand. A structure built on leverage functions until confidence wavers. Confidence depends on perceived ability to deliver. The distinction between price exposure and ownership deserves emphasis. Paper instruments provide exposure to price movement. Physical ownership provides control of metal. In stable conditions, the difference feels academic. Under stress, the difference becomes decisive. If settlement shifts toward cash because physical availability tightens, participants recognize that paper contracts represent financial claims, not guaranteed assets. As delivery begins today, attention focuses on participation rates. If historical norms hold near 3 to 5%, stress may remain contained. If participation rises meaningfully toward recent elevated levels, inventory metrics will face scrutiny. Markets watch data closely during such periods. Transparency amplifies reactions. Speculation about timing is inherently uncertain. Stress may resolve gradually or abruptly. Markets can sustain imbalance longer than expected, yet when resolution occurs, it often compresses into short windows. Decades of accumulated deficits, supply concentration, and growing industrial dependence create a backdrop unlike prior cycles. Ultimately, this is a story about alignment. Inventory depletion aligns with rising lease costs. Negative swap rates align with delivery concentration. Corporate supply agreements align with export tightening. ETF accumulation aligns with macroeconomic strain. Each piece reinforces the others. When multiple indicators point in the same direction, ignoring them becomes increasingly difficult. The coming sessions will not merely reflect price fluctuations. They will test whether a leveraged pricing model can accommodate surging physical interest within a constrained supply environment. They will test whether incentives motivate conversion of eligible inventory or encourage further hoarding. They will test whether confidence remains intact when arithmetic grows uncomfortable. Markets thrive on equilibrium between supply, demand, and trust. When equilibrium shifts, adjustment follows. The magnitude of adjustment depends on participation and response. Today begins a phase where participation becomes measurable. The numbers will speak clearly, and when numbers speak clearly, narratives adjust accordingly. As this delivery cycle unfolds, the central issue is not whether silver will move $5 higher or lower in the short term. The real issue is whether the framework that has priced silver for decades can continue functioning without interruption under visible strain. Markets are ultimately built on trust in process. When process appears stable, leverage is tolerated. When process appears fragile, leverage is questioned. Today, we are at a point where that question is being asked more openly than at any time in recent memory. Consider the arithmetic once more because clarity matters. Approximately 360 million ounces are tied to March futures positions. Registered inventory sits below 100 million ounces, fluctuating between roughly 95 and 105 million. Against that, analyst estimates place the effective paper-to-physical ratio near 360 to 1 when focusing strictly on deliverable metal. Daily vault withdrawals average around 785,000 ounces. The global market remains in a monthly deficit, estimated between 40 and 50 million ounces. Cumulative shortages since 2021 approach 820 million ounces. Those are not emotional arguments. They are measurable figures. Add to that the industrial backdrop. Annual production of 820 to 830 million ounces must satisfy industrial demand of approximately 680 to 700 million ounces before investment demand even enters the equation. Solar expansion continues. Electric vehicle manufacturing advances. Artificial intelligence infrastructure relies on semiconductor fabrication that uses silver in conductive pathways. Medical technologies depend on its antimicrobial properties. None of these demand streams show structural contraction. They represent long-term commitments by governments and corporations worldwide. When supply deficits accumulate year after year, inventory buffers gradually thin. When buffers thin, small disruptions create outsized effects. The silver market's leverage has historically remained manageable because delivery participation was minimal. But recent evidence of participation rates near 98% in a prior cycle indicates that behavioral assumptions can change quickly. If even a fraction of that elevated participation persists, arithmetic becomes uncomfortable. Some argue that cash settlement resolves everything. Technically, it can. Contracts can be fulfilled financially without metal changing hands. No formal default occurs. The exchange continues operating. Yet cash settlement under pressure conveys information. It communicates that metal was not readily available at quoted prices. That signal alone can alter behavior in subsequent cycles. Participants begin pricing in delivery risk. Premiums expand. Hoarding increases. Liquidity contracts further. Eligible inventory is frequently cited as reassurance. On paper, eligible ounces exceed registered ounces, but eligible metal is not obligated to satisfy futures delivery. It belongs to holders who must willingly convert it. Conversion depends on price expectations and strategic considerations. If holders anticipate higher prices driven by deficits, export tightening, and corporate offtake agreements, reluctance to convert increases. The presence of eligible inventory does not guarantee availability at current levels. International dynamics reinforce that hesitation. China's control of roughly 70% of refined silver output introduces geopolitical leverage. When silver is designated a strategic resource and export controls tighten, domestic priorities outweigh global liquidity. Western exchanges cannot rely on uninterrupted flows from Chinese refiners to replenish inventories. Meanwhile, Shanghai trading consistently above Western benchmarks, sometimes by $10 to $20 and briefly by premiums approaching 30% before tax adjustments, signals regional scarcity. Wholesale premiums touching 45 to 48% underscore that divergence. Corporate actions amplify the message. A major technology company securing 2 years of exclusive output from a Mexican mine removes supply from open exchange circulation. That decision reflects forward planning based on anticipated tightness. When corporations bypass exchanges and negotiate directly with producers, they reduce publicly visible supply. If similar agreements proliferate quietly, exchange inventories may face structural headwinds independent of production totals. Macro conditions add fuel to the narrative. Housing affordability pressures, with median prices rising from approximately $270,000 to $415,000, while wages increased only 29%, compress disposable income and strain credit systems. Mortgage rates rising from 2.7% to around 6.3% widen payment burdens. The qualification gap between $127,000 required income and median earnings near $80,000 highlights systemic imbalance. Pending home sales at record lows reflect stress. In periods of financial strain, tangible assets regain attention. Silver's dual industrial and monetary characteristics position it uniquely during such shifts. Exchange-traded funds, holding physical silver at elevated levels, indicate institutional positioning. Rather than relying solely on derivative exposure, capital is moving toward metal-backed vehicles. That shift suggests awareness of delivery sensitivity. Institutions are not prone to impulsive decisions. When positioning changes broadly, it often reflects risk assessment rather than speculation. The violent price collapse earlier in the year, from $121 per ounce to $64 in a single session, provides an instructive case study. Conventional thinking predicts that sharp price drops suppress demand. Instead, 3.3 million ounces were withdrawn from exchange vaults that day. During extreme volatility, sophisticated actors removed physical metal. That behavior highlights the distinction between price action and confidence in availability. When confidence wavers, ownership becomes priority. Now the question becomes timing and magnitude. Does stress manifest gradually through rising premiums and incremental repricing, or does it compress into a short, volatile adjustment? Markets often absorb imbalance longer than observers expect. Yet when thresholds are crossed, moves accelerate. If delivery participation remains moderate, the system may adapt. If participation surges meaningfully, the visible inventory cushion shrinks quickly relative to obligations. The upcoming sessions will reveal whether traditional delivery behavior persists. If 3 to 5% of holders stand for delivery, the exchange likely navigates the cycle without dramatic dislocation. If participation rises toward 25% or beyond, arithmetic tightens rapidly. If participation approaches prior elevated levels near 98%, extraordinary measures may become necessary. Each outcome carries signaling implications for future contracts. It is important to remain measured. Not every imbalance produces collapse. Systems are designed with flexibility precisely to manage strain. Incentives may adjust. Prices may rise enough to unlock supply. Industrial demand may moderate marginally in response to cost. Markets are dynamic. However, dismissing converging indicators would ignore evidence. The convergence is what makes this period distinct. Delivery concentration in near-term contracts aligns with rising lease rates and negative swap rates. Vault withdrawals align with global deficits and cumulative shortages near 820 million ounces. Corporate offtake agreements align with export restrictions. ETF accumulation aligns with macroeconomic stress. These factors do not operate in isolation. They reinforce one another. The core issue is confidence. Paper markets function because participants trust that obligations can be met. If confidence erodes, participants demand higher compensation for risk or shift toward direct ownership. Confidence can remain intact despite imbalance for extended periods. Yet once questioned publicly and repeatedly, it becomes fragile. As of today, delivery begins. Data will emerge session by session. Vault reports will show inflows and outflows. Delivery notices will reveal participation rates. Premium spreads between Shanghai and Western benchmarks will fluctuate. Lease rates and swap rates will signal borrowing pressure. Each data point contributes to a broader narrative. For those holding physical silver, ownership represents insulation from settlement mechanics. Physical metal cannot be diluted by contract creation or resolved in cash without consent. For those trading futures or options, understanding that these instruments provide price exposure rather than guaranteed delivery is essential. Both approaches have roles, but their risk profiles differ during stress. For observers not yet positioned, the structural deficit does not vanish overnight. Cumulative shortages near 820 million ounces and ongoing industrial expansion suggest underlying support. Short-term volatility remains inevitable. The earlier 33% crash demonstrated that swings can be violent. Volatility does not negate structural trends. It accompanies them. Ultimately, this delivery cycle is more than a price event. It is a test of balance between leverage and metal. It is a test of whether paper claims can continue expanding against a finite physical base without forcing repricing. It is a test of institutional confidence in exchange mechanisms during tightening supply. The outcome may unfold gradually or rapidly. It may result in controlled adjustment or significant dislocation. Certainty is impossible. What is clear is that conditions for meaningful movement exist in ways not seen for decades. Arithmetic, incentives, and global policy shifts have aligned. Today marks the beginning of observation rather than prediction. The numbers will determine the narrative. If participation remains contained, stability continues. If participation expands materially, repricing becomes likely. Markets always resolve imbalance eventually. The only uncertainty is how and when. Watch the vault data. Watch delivery notices. Watch premiums across regions. Watch lease rates and swap spreads. These are not abstract statistics. They are signals of supply tension within a leveraged framework. The coming period may define whether the current pricing model remains credible or whether it requires adjustment to reflect physical reality more accurately. Confidence, once questioned, rarely returns unchanged, and in markets built on leverage, confidence is everything.